Hello, Marc from ADM Investor Services International. Some thoughts this week on the implications of major central banks being lower for longer and how this is playing out in credit markets around the world. We haven't reviewed this for quite a while. So the first table I've got is a familiar one. It's from Bloomberg, the market implied policy rate outlook. And as one can see, out to 3 years, which is what the period covers, we are looking at flat policy trajectories in pretty much every major economy. Elsewhere in the emerging market space, a fairly sharp rise expected in Brazil for rates as we go forward, starting at the end of next year. Slightly smaller upward gradients seen in places like Chile, the Czech Republic, and indeed India. But overall, a very benign environment for corporate credit borrowers. And so let's have a look at what we've got in terms of the performance thus far this year. So the second chart is the US investment grade average spread. As one can see, we are basically at 102 basis points at the lows that we were back in January, pre the pandemic crisis. Very, very steady picture. Obviously even better in terms for corporates. Obviously this is an average spread, therefore it doesn't necessarily reflect some divergences amongst the better rated borrowers. But the more interesting aspect, I think, is in the high yield space. So the final four charts are all relating to that particular area, starting off with US high yield. And remembering, obviously, that the key component of this US high yield market is the energy sector. This is basically making a new low. We're down at 399 basis points as an average high yield spread. That is very, very tight, one would have to say, but it still represents a fairly large premium relative to US treasuries. Over in the European space, if you thought that the US high yield levels spreads aren't particularly generous, well then take a look at this fourth chart, which is European or euro denominated high yield, and that has a spread of just 285 basis points, and as one can see, this is also at the pre-COVID lows. Now, the final two charts tell us something about what the difference is between having central banks hoovering up every form of bonds that they can possibly provide a backstop for and not. So we have, in the first instance, the JP Morgan emerging market bond spread. As one can see, the spread is currently at 339 basis points. That's roughly about 50 basis points above the pre-COVID low. So we've chased the spreads down very significantly relative to where we were. A lot of this basically is both to do with Latin America and also to do with Asia, particularly in China. Some of the spreads there widening with the recent defaults that we're seeing, obviously exercising some upward pressure. But the final chart is perhaps the most instructive one about not having central banks intervening, remembering that the bulk of the borrowers in the Asian US dollar denominated high yield space are not from Japan, they are from all the other parts of Asia. So here, with the Barclays average spread, what we've got is an average spread of 672 basis points. That's a whopping 240 basis points above where we were in January. Other side of that coin is obviously that Asia is still expected to be the area which sees the strongest recovery from the pandemic. As and when we get to it, it's already outperforming certainly Europe and North America, and certainly Latin America, which is continuing to struggle. But it certainly underlines here that there is a much greater credit risk premium factored in. And on the other hand, it underlines the fact that obviously there aren't central banks hoovering up all that dollar debt there. So those are thoughts for this week.